Hello. Hello, good morning.
Good morning, sir.
Hello, can you hear me? Hello, good morning. Can you hear me? If you can hear me, please tap in chat in the box, chat box, that you can hear me. Lakshman, are you there? Okay, you can hear me. Asma Begum, you can hear me, right? Can I start the class?
Yes, sir.
Okay, thank you, thank you. So good morning, all of you. My name is Dr. Rabindranath, and I'm going to take up Income Tax 2 class for you. Now, can anybody tell me up till what you have covered in your offline classes so that I can take it forward from there? Are you able to listen to me?
Yes, sir.
Okay, Deepa, can you tell me up till what you have covered in your offline class? You had offline classes, right?
Sir, I don't know, sir. I have no idea
Okay,
what offline class.
See, I am going to use these classes to specifically prepare you for your final exams. Okay. So if anybody is not able to understand, please chat in the chat box. Tell me, stop me so that I will again come back to you. Okay. So first of all, if you see in your model in the contents, in the first block, you have got aggregation and reductions. So if you look at your examination, pattern of examination, from each block, you will get at least 2 questions. So in this class, I am going to talk about the first block, that is Unit 1 and Unit 2. Okay. So in the first unit, you have got clubbing of income. In the second unit, you have got set off and carry forward of losses. Now, in this unit, that is Unit 1, clubbing of income, we have to understand what is clubbing. Why is it done? What is the purpose of clubbing the incomes? Now, you know that there are certain incomes which, even though they do not belong to the SSC, they will be taxable in the hands of the SSC. that is income belonging to others, is included in the income of the assessee. Now, what are the reasons or what are the cases where the income of others is included in the income of the assessee? The first one is due to transfer of income under section 16. Now, here what happens is every income will have a source from which the income arises. Suppose, for example, you have got income from salary. The source is your job. You have income from house property. The source is the house that you have constructed and given on rent. You have got income from capital gain. That is, the source is the gain that you got from transferring your capital asset. So like that, every income will have a source. Now, where a person transfers the income without transferring the source, that is, the house property will be in the name of the assessee himself, but the income is shown in somebody else's income statement. Now, this is a case of transfer of income without transferring the source. So, where there is a transfer of income without transfer of source, the transferor is liable to pay tax. Therefore, in this case, the income is clubbed in the hands of the transfer. Okay. So this will be taxed in the hands of the assessee. Take, for example, Mr. X is there. Mr. X has got a house and is getting some income out of that house. So what Mr. X will do is he will transfer the income to his relative Y with the intention of avoiding the payment of tax on this income. He will transfer this to Y. This is known as transfer of income without transfer of asset. In this case, it is the transferor, that is X, who will pay tax, but not the transfer. So this is a case of clubbing of income. Am I clear about this point? Anybody, any doubt here?
Sir, once again about clubbing of income.
Once again?
Yes, sir.
See, actually what happens is, the reason why income is clubbed is because to avoid the escaping of tax. Okay, it is to avoid the tax evasion. Clubbing is done. What is clubbing? Clubbing
Means to avoid the income, they will transfer the income to other.
Correct, correct. To avoid the payment of tax on that income, what they will do is they will transfer this income to somebody else. But the source of income is with them only. In this case, it will be clubbed in the hands of the person who transfers the income. Second is revocable transfer of asset. What is the meaning of revoke? Revoke means to call back or to withdraw.
Return.
Yes, very good. To return. Now here, what happens is that there is an agreement in which one person transfers one property or one asset to another person just before the date of end of the assessment year. So when he transfers this, after the assessment year is over, again, the asset will revoke back to the person who has transferred. Why this is done? This is done because on that date, on whoever's name the asset is there. Suppose, for example, there are dividends. Dividends are paid every 6 months or sometimes annually. So just before the payment of dividend, one person, X, will transfer the shares to Y. So on the date of payment of dividend, the shares are in the name of Y. Dividend is paid to Y. Then afterwards, the shares are again transferred back to X. This is another case of avoiding the payment of tax, or rather it is tax evasion. In this case also, this is called revocable transfer of asset. That is, the asset reverts back to the person who has transferred it. This is under section 61. Then commission of salary or commission, salary, etc. of spouse. Now here, any payment by way of salary, whether in cash received by the spouse from a concern in which the individual has substantial interest. Okay. Suppose, for example, what happens is you have a company. Now, in this company, you are getting some commission. What you will do is you will transfer the commission on the name of your spouse. So, this commission is not shown as your income. It will be shown as your spouse's income, your wife's income. Now, in this situation, it is wife who should pay tax. But because you have got a substantial interest in the company, it is you who should pay tax, but not the wife. So this also is a case of clubbing of income. Okay. Then income of spouse from the assets transferred. Here also, where assets are transferred in the name of the spouse, only with the intention of avoiding the payment of tax, it is the person who has transferred in that person's hands, the income is taxable, but not in the hands of the spouse. Okay. Now these are examples of clubbing of income where there is transfer of any asset either to the spouse or to the son's wife, or for the benefit of spouse or the benefit of son's wife, or for the transfer of any person. But the benefit is for the SSC, for the person making the transfer. In that case, it is the person who transfers who is liable to pay tax, but not the transferee. Okay. Any doubts here? Okay. Then one important section is section 64(1)(a). Now, under section 64(1)(a), income earned by a minor person is treated. Okay. Who is a minor? A minor is a person who has not attained 18 years of age. Now, according to the Indian Contract Act, any contract with a minor is not valid. So, if the minor has got an income, okay, as per the Indian Contract Act, you cannot enter into a contract with the minor. So, minor's income will not be taxed in the hands of the minor himself. It will be taxed in the hands of the guardian or parent. Now, here you see, income does not belong to the parent. It belongs to the minor. But the minor is not taxed. It is taxed in the hands of the guardian, in the hands of the parent. Now here, in whose hands should the income be taxed? Is it the father or the mother? In this case, what happens is any person, okay, when the income is being clubbed, any person whose income is less, in that person's hands, the income would be taxed. The income would be clubbed in the hands of the person who has got less taxable income among the parents. If the mother has got less taxable income, in the hands of the mother. If the father has got less taxable income, in the hands of the father. And one important thing that you have to remember here is where any income is taxed in the hands of the minor, then the person in whose hands the income is taxed, that person will be given an exemption. Exemption in the sense that he will be given an exemption of rupees 1,500. He will be given an exemption of rupees 1,500 because the income does not belong to him. Okay. So this point you have to remember. Any doubts here, please, up till now?
No, sir.
Okay, thank you. Then, do you have the study material in front of you?
Yes, sir.
Okay, so in the study material, now I am going to deal with unit 2. Now, unit 2 is very, very important from the examination point of view. As I've already told you, that I am going to specifically deal with the topics depending upon their importance in the examinations. Okay, so this particular unit is very important in the sense you will definitely get one essay question with regard to set off and carry forward of losses, which is your second unit. Okay, now first we will understand what is the meaning of set off, what is the meaning of carry forward. Set off means deducting or setting off. That is where a person has got positive income from one source. See, you all know that there are 5 heads of income. What are the 5 heads of income? Income from salary, income from house property, income from capital gain, income from business or profession, income from other sources. These are the 5 heads of income. They are known as the 5 heads of income. Now, if you add all the heads of income, what you get is called gross total income. From the gross total income, you give deductions under section 80. After you give deductions under section 80, you get taxable income. Now, this taxable income may either be positive or negative. Positive means that you will have a plus income. Say income from salary is 1,20,000. Example, income from salary is 1,20,000. Now, you also have one house property which you have given on rent. Assume that you got a loss from house property. So your first head of income, income from salary, is positive. It is plus. But your second head of income, that is income from house property, has a loss. It is negative. Okay. So assume that it is a loss of rupees 20,000. So what you do is you take the income from house property from that, you take income from salary, 1,20,000. From that, deduct loss from house property, 20,000. Okay. Now this deducting is called setting off, reducing the negative income from the positive income. So in this case, what is the total income of the person? Total income of the person is 1 lakh. That is salary 1,20,000 minus house property loss 20,000, the net income, the net total income is 1 lakh. Now here, what we have done is we have set off the loss. We have deducted the loss from the income available. This is known as setting off of losses. Now, what is the meaning of carry forward? Suppose, for example, whatever income is there is not sufficient to set off the loss. Then such a loss which could not be deducted will be transferred to the next year. It will be carried forward to the next year. That is called as carry forward. Okay. Setting off means where you have got positive income from one head and negative income from other head. The positive income will be used to deduct, that is set off the loss from the other head. Where the positive income is less, negative income is more, it cannot be completely set off. Such a loss will be carried forward to the next assessment year. This is the meaning of set off and carry forward. Am I clear here? Excuse me. Am I clear?
Yes, sir.
Okay. Now, see, setting off and carry forward of losses has to be done according to the Income Tax Act. Okay, you cannot set off and carry forward losses in the way in which you want to. Okay. So, for the purpose of finding out, or for the purpose of knowing how the income from one head is set off from other head, you have to look at the rules under section 70 to 74 of the Income Tax Act. Section 70 to section 74. Okay. Now here, first we will talk of section 70. Section 70 talks about intra-head set-off. Intra means within the same source. I'll give you an example. Suppose Mr. X has a house in Bombay and another house in Hyderabad. Okay. Both of them are under the same head called income from house property. The house in Bombay and the house in Hyderabad will be clubbed as income from house property only. Further assume that from the house property in Bombay, he has a loss. And from the house property in Hyderabad, he has a profit. Okay. Now here, what you will do is from the profit, from the income available from the house in Hyderabad, the loss from the house in Bombay will be deducted, will be set off. This is called intra-head set-off. That is deducting the loss available, the loss incurred in one source from the profit available in another source within the same head is called intra-head set-off. Okay. So here, what has happened? That the income available from the house property in Mumbai is being used to set off the loss from the house property in Hyderabad. So here what we have done is we have used one source in which income is available and we have deducted the loss from another source within the same head. So when it is within the same head, it is called intra-head set-off. That is under section 70. Then under section 71, where intra-head set-off is not possible. That is, there is no income within the same head to deduct the loss in that head. In that situation, you will use section 71. Now, section 71 talks about inter-head set-off. Inter means between. Intra means within. Okay. So where within the same head, the loss is huge, while the income is less, the loss is not deducted completely. Then you go to the second step, that is inter-head set-off. That is, the loss from one head is deducted from other head of income. So here there are two heads. That is why you call that as inter-head set-off. Where the loss is set off from the same head, it is called intra-head set-off. Okay. You may get a short question. What is intra-head set-off and what is inter-head set-off? So here you should be able to explain that intra-head set-off is where the loss from one source is deducted from the profits of another source. It is called intra-head set-off. Then what is inter-head set-off? Where the loss from one head is set off from the profits of another head. It is called inter-head set-off. Very plain and very simple. So here we have discussed section 70 and section 71. Section 70, intra-head. Section 71, inter-head. Now the next section is section 73, subsection 1. Now, the reason why I am discussing section 70, 71, 73, and 74 is that these are the only sections which you have to remember and keep in mind when you are setting off the losses. Okay, so first we have seen intra-head, then we have seen inter-head. Now we are going to see section 73, subsection 1, which talks about loss from speculation business. Now, this particular loss is available only for income from business. Now, business is of two types. Either it is speculation business or non-speculation business. What is a speculation business and what is a non-speculation business? A business in which the actual delivery of goods and services does not take place. That business is called speculation business. That is speculation in gold, speculation in silver, speculation in shares. Okay, here what happens? Actual delivery of goods and services is not taking place, but only a speculative profit or speculative loss will be incurred. An example, X says that today the price of shares in company A is rupees 1,000 per share. I want to sell these shares on the 30th of this month at this price only. That is 1,000 per share. Okay. So on 30th of this month, the price of the share may be 1,000. It may be 1,200. So on 30th of April, okay, on 30th of April, if the price of the share is, assume 1,200. Okay. If the price of the share is 1,200, then he will get a gain of 200 rupees. Okay. If the price of the share is only 900, okay, he sold that, he is going to sell for 1,000. He will get a loss of 100. This is called speculation gain or speculation loss. Actual delivery of shares will not take place. It is only a speculation that he has done. This is called speculation business. A business that is not speculative in nature is known as non-speculation business. It is a general business. It is a business in which goods and services are exchanged. That kind of a business is called non-speculation or general business. Okay. Now here, as I was telling you, we will talk about section 73 subsection 1. Now section 73 subsection 1 talks about loss from speculation business. Now here I have told you intra-head set-off and inter-head set-off. For loss from speculation, inter-head set-off is not available. Only within the same head, that is income from business, that too income from other speculation business only, the loss from speculation can be set off. I will repeat again. If a person has got loss from speculation in gold and he has got income from speculating in silver, he can use the income from speculation in silver to deduct the loss from speculation in gold. This is called intra-head, inter-source setup. Within the same head, from the same source, that is speculation, loss can be set off. In the same head, you cannot set off speculation loss from non-speculative profits. Okay. Non-speculative profits cannot be used to set off speculative loss. Okay. This is about section 73, subsection 1. Then coming to section 74. Section 74 talks about the loss from the activity of owning and maintaining racehorses. Okay. Now, you know that there are 5 heads of income. And in these 5 heads of income, the last head of income is called income from other source. In income from other source, you have 2 types of income: general income, casual income. General incomes are taxed at a flat rate, at the rate of slab rates. Well, sorry? Excuse me. Anybody has got a doubt here? Okay, so I'm continuing. So the income from other source is divided into 2. That is general income and casual incomes. Casual incomes are taxed at a flat rate of 30%. Within the casual incomes, you have got income from winning from lottery, income from winning from crossword puzzles, and income from the activity of owning and maintaining racehorses. Income from the activity of owning and maintaining racehorses has got a special treatment. Special treatment in the sense that any loss from the activity of owning and maintaining racehorses can be set off from a similar activity. You cannot use the other casual incomes also. You cannot use income from winning from lottery, winning from crossword puzzles. Within the source also, it is not available. Income will not be made available to set off the loss from the activity of owning and maintaining racehorses. Okay. So these are sections 71, 70, 71, 73, and 74 of the Income Tax Act, which specifically deal with the income for setting off of losses. Then coming to the carry forward of losses. Okay. Now, what is the meaning of carry forward? What is carry forward? I've already told you that where the income is not sufficient, it has to be carried forward for the next assessment year. So when you are carrying forward the loss from one head to the next assessment year, there are certain rules that you have to keep in mind. Okay. So what are the rules that you have to keep in mind when you are setting off the loss from the heads of income? We will discuss each of the head and then we will see how it has to be carried forward. What is the first head of income? The first head of income is called income from salary. Will there be any loss from income from salary? Will there be a loss? At best, you may not get salary. Okay. If you are working, the employer, if he pays you salary, you will get it. If he does not pay you salary, you will not get salary. It will be zero. But the employer will not take anything away from you. So there cannot be a loss from salary. Okay. Then coming to the second head, that is income from house property. Now, in income from house property, there may be a loss. How will you get loss from house property? You know how to calculate income from house property. First, you calculate the gross annual value. What is gross annual value? Gross annual value is municipal rental value, fair rental value, actual rental value, whichever is higher is gross annual value. From the gross annual value, you give deduction for municipal taxes paid by the owner. So from the GAV, when you deduct municipal taxes, what you get is called net annual value, which is NAV. From the net annual value, you have to give only two deductions under section 24. That is 24A and 24B. What is 24A? 24A is a standard or statutory deduction, which is equal to 30% of NAV. Okay. What is NAV? GAV minus municipal taxes is NAV. From that NAV, give deductions under section 24. The first deduction is 24A, which is a standard or statutory deduction. That is 30% of net annual value. Then the second deduction is 24B. 24B is interest on loan taken to purchase, construct, repair, renovate, or reconstruct the house. if the loan is taken for any of these 5 purposes, that is for the purpose of purchasing the house, for the purpose of constructing the house, for the purpose of repairing the house, for the purpose of renovating the house, for the purpose of reconstructing the house. Remember, if the loan is taken for any other purpose, deduction cannot be given. So from the NAV, when you give deduction under section 24A, standard deduction, and 24B, interest on loan taken for the purpose of purchase, construction, repair, renovation, reconstruction, the resultant figure is income from house property. Now, this income from house property may be positive, may be negative. How it will be negative? It will be negative when from the NAV, after you give deduction from 24 for 24A and 24B, you get a negative figure. That is, interest paid is more than the rental income that you have received. Interest paid is more than the rental income that you have received. You get a loss. Now, this loss, as the first step, has to be set off from any other house property that you have. Suppose you do not have other house property. Then you have to set it off from other heads of income. Other heads of income are salary, capital gain, business, or other source. Suppose the other heads of income available also is not sufficient, then this house property loss will be carried forward to the next assessment year. And it will be carried forward for a period of 8 assessment years. And subsequently, from the next assessment year onwards, it will be set off from income from house property only. You will not have the other heads of income available to set off this loss if it is carried forward to the next assessment year. So like this, for 8 assessment years, you can carry forward the loss from house property. Okay. So first head we said income from salary. It does not have a negative figure. So the question of loss does not arise. So no set off, no carry forward. Then the second head is income from house property, where there is a negative figure, where there is a loss. It can be set off from other houses in the same year or other heads in the same year. And still, if the loss remains, carried forward for the next subsequent 8 assessment years to be set off only from house property income in the subsequent years. Coming to the third head of income, which is income from business or profession. Now, income from business, a short while ago, I was explaining to you that business income is of 2 types, speculation and non-speculation. We have already seen how to deal with speculation loss. In the sense, it has to be deducted from other speculation losses or carried forward to the next year. And it can be carried forward only for 4 assessment years. Unlike other incomes, which can be carried forward for 8 years, the loss from the activity of owning and maintaining racehorses can be carried forward only for 4 assessment years. And speculation loss can be carried forward to be set off from speculation profits in the next assessment year. While coming to non-speculation loss can be set off from other non-speculating profits or can be set off from other speculating profits. So here you see non-speculation loss can be set off from other non-speculative incomes and other speculative incomes also. You can use speculative incomes to set off your non-speculative loss. And if the loss is still available, then it has to be set off from the other heads of income in the same year. If it is not completely set off, can be carried forward for 4 assessment years. For 8 assessment years. Which one? The non-speculative loss. Then coming to income from capital gain. What is capital gain? The gain that you get from transferring a capital asset is known as capital gain. Now, usually what happens is you purchase a capital asset, say for rupees 10 lakhs, and then subsequently, after a few years, you sell off the asset, say for 12 lakhs. Your purchase price is 10 lakhs. Your selling price is 12 lakhs. From the selling price, which is known as sale consideration, when you deduct the purchase price, which is known as the cost of acquisition, if the resultant figure is positive, you get a gain. If it is negative, you get a loss. And this gain may either be a short-term capital gain or long-term capital gain. Now, what is short-term capital gain and what is long-term capital gain? The gain that arises on the transfer of a short-term capital asset is known as short-term capital gain. The gain that arises on the transfer of a long-term capital asset is known as long-term capital gain. Now, what is short-term capital asset and what is long-term capital asset? An asset which is held for a period of less than 3 years before it is sold, such an asset is called short-term capital asset. Okay, say I purchased a house in the year 2009 and I sell this off in the year 2011. So what is my period of holding? 9, from 9 to 10, 1 year, from 10 to 11, 2 years. So within 2 years, I have sold off the house. The gain that I get is called short-term capital gain. Suppose I sell off this asset in the year 2015. I purchased this in 2009 and I'm selling off in 2015. So for how many years the period of holding is there? From 9 to 10, 1 year, 10 to 11, 11 to 12, 12 to 13, 13 to 14, and 14 to 15. 6 years, the asset is with me. That is, the period of holding is 6 years. So where the period of holding is more than 3 years, that asset is called long-term capital asset. And the gain I get is called long-term capital gain. Okay. So why do you think that this differentiation is made? The differentiation is made because short-term capital gains are taxed as per the slab rates, while long-term capital gains are taxed at a flat rate of 20%. That is why this distinction is made. And more so, the treatment with regard to set off and carry forward also is different for short-term and long-term assets. Short-term and long-term capital gains. First, we will discuss about short-term capital loss. So if there is a short-term capital loss, it has to be deducted from other short-term capital gain if available, or it can be deducted from long-term capital gain if available. Otherwise, it has to be carried forward for 8 assessment years. Coming to long-term capital loss should be deducted from long-term capital gain only if available. If no long-term capital gain is available, it has to be carried forward to the subsequent 8 assessment years. That is why we have discussed about short-term and long-term capital gain or capital losses. Then the last head of income is income from other sources. I've already told you, income from other source is of 2 types. Either it is your regular income or a casual income. Here also distinction is made between your regular incomes and casual incomes. What are the casual incomes? Casual incomes, as already explained, are incomes that arise by way of an element of chance. The SSC does not make any efforts to earn that income. It is purely on the basis of luck. The element of luck will be present when you earn this income. It is casual in nature. That is, it is not regular. And the SSC's efforts are not there to earn that income. For example, winning in lottery. The SSC will only purchase a lottery ticket. The rest depends upon the luck, whether he will get the lottery or he will not get the lottery. He will not make any efforts. That income is called casual income. Income from betting. Income from TV game shows. Income from card games. All these are called casual incomes. Then these casual incomes, they cannot be set off from other regular incomes in the same head. They cannot be set off from the other heads of income. They can only be carried forward. Now here you understand that within the casual incomes, you will have loss only from one source. That is from the activity of owning and maintaining racehorses. Because for lottery, you will not get a loss. For card games, for TV shows, you will not get a loss. You will get a loss only for the activity of owning and maintaining racehorses. So there, if you have a loss, it can be set off from a similar activity. If no such income is available under a similar activity, it has to be carried forward. For how many years? For 4 assessment years only. This is with regard to the rules of set off and carry forward of incomes. Okay. So first what you have to do is you have to set off the loss within the same head called as intra-head set off. After that, go to the other heads of income within the same year. That is known as inter-head set off. If loss from intra and inter-head is not available, then it can be carried forward to the subsequent assessment years based upon the rules that we have discussed just. For all incomes, it can be carried forward for 8 assessment years, except for the activity of owning and maintaining racehorses, which is for 4 assessment years. Okay, this is with regard to income from set off and carry forward of losses. Now, what are the major questions that you will get with regard to income from set off and carry forward of losses. So usually what happens is you will get one theory question, you will get one problem. Okay. The theory question will be, what are the rules regarding set off and carry forward of losses under the Income Tax Act? Okay. This will be the question. So here you will have to explain what all you have seen just, what all we have discussed just now. You have to explain this in a sequential order. That's it. Nothing beyond. If you get a problem, what he will do is, he will give you some items of profit, some items of losses, and ask you to find out the net income. Okay. What is net income? Income from one head minus loss from other heads is known as net income. That you have to find. So when you are deducting, you have to keep all these rules in mind, and then you have to do this intra-head and inter-head setting off and carry forward. That is your ultimate problem in block 1. Okay. So this is with regard to the first block that we have discussed today. In case you have got any doubts, please type in the chat box. We will try to answer it. Otherwise, I will close this session. Am I good to go? Are you people there? Okay, then I'm leaving. See you tomorrow for the next class. And thank you all.